everyone. Welcome to this month's Fixed Income Outlook. I am Shalini and joining me today is Devang Shah. In today's episode, Devang will walk us through the market developments of 2024 and his outlook for 2025. Devang, 2024 has been an eventful year for fixed income. Can you give a recap of 2024 to our investors?
Thanks, Shalini. First of all, wishing you a very happy new year to all our investors. I'll start with the recap as Shalini highlighted. I think last year we predicted three main reasons why fixed income markets would do well in 2024. First, the macroeconomic story in India has become very, very positive. And the general reason is with inflation coming down. The second reason is we saw global rates easing with the Fed and other central banks cutting rates. The third important reason for bond markets to do well was inclusion of Indian bonds in JP Morgan indices. This inclusion brought us more than 1 trillion of inflows in Indian debt market. So I think these factors, which are positive macros, falling inflation, global easing of rates, and inclusion of Indian bonds in global indices, contributed to the performance of bond markets in India.
Going forward, what factors can drive the performance of debt funds in 2025 and what factors can impact performance?
That's a good question, Shalini. In fact, for 2025, we believe that the major driver for performance would be RBI would start the rate cut cycle. And why we expect that? We expect actually a 50 basis of rate cuts in the next 6 to 12 months. The reason for this would be the slower GDP growth. We have already seen a lower print in Q2. We expect the Q3 and Q4 GDP also to be low. This would prompt RBI to change its course and start cutting rates. Another important factor which would be positive for bonds and driving the bond markets would be the favorable demand supply dynamics. We believe that fiscal consolidation will continue by the government. We anticipate the fiscal deficit for 2026 to be below 4.5% and which will lead to rally in bond markets.
What are the key risks investors should watch out for?
The key risks, if I think at this point of time, are currency and banking liquidity. They are the near-term problems. On a real effective exchange rate basis, we are actually expensive and hence we can see some currency depreciation. Pressure on currency generally keeps RBI on a cautious mode and liquidity can get tightened, which could be a risk investors should watch out for. Another important risk can be a faster than anticipated China rebound. Could lead to a vicious cycle for India, that we go through a slow growth patch, we see FPI outflows and inflation coming back. So I think these are the key risks if I summarize.
Any advice for debt investors building their portfolios for 2025? Are there any factors they should consider or any mistakes they should avoid?
Like last year, I think for 2025, again, we are very bullish on bonds and we will advise investors to have a higher allocation to bond markets and debt portfolios. With weakening growth and controlled inflation, investors should continue to have a higher debt allocations and they should consider staying invested in long duration funds, as most of the gains in such funds are traditionally come before the rate cuts start. After the first couple of rate cuts, investors then could start to strategize to move out of these funds and move to other options like short to medium term funds. Unless we see a significant economic slowdown or we see a probability of us getting added to Bloomberg indices, I think then the case for long duration bonds continue. Mistakes which investors should avoid is to stay invested in long duration funds for too long after the rate cycle is done. Investors could continue to shift to other parking solutions or short to medium term funds once the rate cycle is over.
Well said, Devang. Thank you for joining me today and thank you all for tuning in to this month's Fixed Income Outlook. See you next month.
Wish you all a very happy and a prosperous new year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.